Let's talk about one of the most misunderstood and most powerful tax planning strategies for UK directors, family payroll. Paying your spouse or children through your limited company can be completely legitimate, but it has to pass what HMRC calls the wholly and exclusively test under Section 54 of the Corporation Tax Act 2009. This is where a lot of directors and even some accountants get it wrong. So let's walk through the caveats, nuances, and how to do it properly. If your family members genuinely perform work for your business, admin, marketing, bookkeeping, packaging, customer service, social media, you can pay them a proper salary through the company. That salary becomes a deductible expense, reducing your taxable profit and your corporation tax bill. But it only qualifies if it's incurred wholly and exclusively for the purposes of the trade. The wholly and exclusively rule means every expense must have a clear, genuine business purpose. In HMRC's eyes, that means no private element, no personal motive, purely business. So if your spouse or child is genuinely helping in the company and you pay them a fair, commercially justified wage for that work, the cost is deductible. But if the payment's inflated or can't be evidenced, HMRC will disallow it. Let's say you pay your 17-year-old son £6,000 a year to help with admin and social media. He earns under the personal allowance, so no income tax or national insurance is due. The business deducts that £6,000, saving £1,500 in corporation tax. If you'd taken that same £6,000 as dividends, you'd lose around £2,000 in dividend tax. Same family, same money, but now HMRC gets zero. Now here's where people get it wrong, and these caveats and nuances matter. The work must be genuine and age appropriate. The pay must be reasonable for the role. That doesn't mean minimum wage, but a genuine wage, market rate. That's the reasonableness test. You don't need corporate level admin. A simple employment letter, pay slip, or proof they actually do the job is enough. This arrangement has to have commercial substance, not just family goodwill. HMRC doesn't care that it's your spouse or your child. They care whether you can justify it. If your spouse genuinely supports the business, maybe they handle bookkeeping, client onboarding, admin, whatever, paying them around £9,000 per year is usually the sweet spot. It's under the income tax threshold. It qualifies them for national insurance credits. It's fully deductible for the company. From the 6th of April 2025, Employers NI rose to 15% on salaries above £5,000, but eligible companies can offset up to £10,500 a year with Employment Allowance. A single director company with no other employees still can't claim the Employment Allowance. You need another employee generating secondary Class 1 national insurance contributions. Now, let's take it one step further. Putting your spouse on the payroll is great, but what about making them a shareholder? I love this question because it says so much about a couple. Some people tell me that their relationship's all built on trust and teamwork, and that's great because this strategy works well for you. And then others start talking about exit strategies and divorce. But honestly, it doesn't matter what state your marriage or relationship is in. If it ever ends, your spouse is getting half in the settlement anyway, so you might as well make the most of it while you're together and use the relationship for tax savings. So here's how it works. If you and your spouse each own shares in the company, you can split dividends between you. That means you each use your own personal allowance, your own basic rate band, and your own dividend allowance, which can easily save thousands every year. For example, instead of one director taking £80,000 and paying the higher dividend rate of 33.75% on everything above 50,000, two shareholders can take 40,000 each and keep every penny within the basic 8.75% dividend band. But you can't just transfer shares for appearances. It has to be a genuine ownership transfer. You need to record it properly at Companies House and issue updated share certificates. And if you ever sell the business, remember your spouse owns part of it legally and financially. The way I see it though, if you trust them with your house and your family, you can probably trust them with half your company. Once you've got your salary, dividends and share split optimised, that's your complete extraction strategy done for 2025. The next step is tracking how those changes impact your real take-home pay, and that's exactly what we cover inside the tax game plan, and you can download it in the description below. Thank you.